not available in public domain. It is being recorded privately so that we can share with the participants at a later stage. So the discussion that we would have during these 10 days is basically on the practical aspects that we as taxpayers or professionals are facing. And that is the brief that we have discussed with our learned faculties also. So with these few words, I will just put on our ACI theme song. Just a second. Since this is the first day, so we would
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्योर्मामृतं गमय ॐ शान्ति 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 असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्योर्मामृतं गमय ॐ शान्ति शान्ति शान्ति।
So this certificate course is being organized by ACAE, which is one of the premier organizations, professional bodies in this part of the country. And this is being done in association with AIFTP, Eastern Zone, the Indirect Tax Professionals Association Forum, and the STAR, which is based in New Delhi. Our online partner is taxguru.com. So with these few words now, I will hand it over to Shubham. Shubham, you can say a few words and then maybe hand it over to Siddhant to formally introduce our learned speaker.
Thank you so much. I think I would like to first of all say that this certificate course has been very well curated. It has been made for the benefit of all the participants. The last 3 years we have been organizing this course, and we have always got a very good feedback in terms of the value addition that the participants are receiving. So we have tried to make this an advanced level course. A lot of our participants are also repeating this course. So we are also making this a course wherein we can have maximum number of legal issues that can be discussed, because we want to make it as practical as possible. The idea is basically not to discuss each and every provision of the law. The idea is basically to have the major practical problems that we are facing that we wanted to highlight here. And obviously with regard to the case laws which are directly impacting those kind of scenarios also would be covered here. So the best of faculties throughout the country have been very kind enough to give their time on this particular course, wherein we are receiving very good feedback from a lot of participants in terms of the faculties that we are coming in. So request you all to cling on to this course for the next 10 days, because I'm sure there'll be a lot of value additions for all of us. Let's try and attend each and every day. Let's not wait for the recordings, because those recordings will not help us, first of all, to ask questions physically to the speaker. Also, whatever live sessions that we are getting, based on the participants' feedback, we also convey that to the faculty also. So our idea is basically to get as much value addition for the participants as possible. You can feel free to ask as many questions. Also, there's a WhatsApp group which is being created for every participant who have been added there. You can let us know also if you have not been added. So in those WhatsApp groups, we are trying to address as many issues as possible. We'll also share the background material that we'll be receiving from each of the faculties on a regular basis. So every day we have one speaker who will be taking a session for 2 hours, and we'll also have a quick Q&A at the end of the session. So we hope that everyone benefits from this particular course, and we are thankful to Abhay Desai sir, who has taken his precious time out out of his extremely busy schedule. He was just in the tribunal a while back. He's come for this session for all of us. We are really looking forward to the benefits that we can receive from his deliberation, because I have seen him personally, and the kind of value additions that he provides, it's very rare to see these days when it comes to topics like offenses and penalties. We don't see a lot of people being able to add those kind of values, because this is a regular topic that we hear in different forums. But when it comes to the number of case laws, the number of practical issues that sir shares, I think this is something which is going to be a very big value addition session for us for the next 2 hours. So thank you, sir, for giving your precious time. And I would like to now give it back to Tarun Bhaiya, and maybe thereafter Siddhant can take the session forward. And thank you.
Thank you. Thank you, Shubham. Arun Agarwal ji has joined. Arun Bhaiya, are you there? I made you the co-host. If you can just come in and say, give us words of guidance. Arun Bhaiya? I think this is not there. Anyways,
he may not be the same Arun. We don't know.
No, could be. Anyways, so now I request Siddhant to formally introduce our learned speaker and start the session. Thank you.
Thank you, Tarun Bhaiya, for the opportunity. Very, very good evening to everyone present here. I would like to now introduce the speaker of the day, Mr. Acae Desai. So today is our first technical session, and we have the perfect person with the perfect topic for the technical session. So Mr. Acae Desai is a CA and a qualified lawyer. After getting rank in CA examination, he started to practice with Yogesh Desai and Company, Chartered Accountants, as a partner. He founded a law firm, Desai Legal, in April 2022, and since then he is practicing as an advocate. He specializes in the field of taxation and renders advisory services as well as litigation services up to the Honorable Supreme Court of India. He is an expert in handling complex issues in indirect taxation. His book on Sabka Vikas Dispute Resolution Scheme has been published by the prestigious Chamber of Tax Consultants, Mumbai. He is also one of the contributors to our very own ICA's publication on GST annual return and audits. He has been co-opted as a member of Indirect Tax Committee of ICAI for financial year 18-19 and again in 21-22. He is also a member of Indirect Tax Committee of Chamber of Tax Consultants, Mumbai. He has addressed more than 500 seminars on indirect taxation and has published more than 500 articles in leading journals. His thesis on recovery and attachment proceedings under GWAT law has been published in the International Research Journal of Management and Commerce, published by Associated Asia Research Foundation. He is the winner of all Gujarat elocution competition held by Bar Association. He is also awarded as the best column or paper writer by the Gujarat Sales Tax Bar Association, and the list goes on and on. The list of sir doesn't end. He is the perfect man for today when we talk about offenses and penalties. And so we would like you to welcome and please take the session and please give us some knowledge on the same topic. Thank you, sir. We very, very welcome, sir, to our forum.
Thank you. So first, I hope I am audible. So first and foremost, I'm grateful to the ACAE, that is the Star Association from eastern part of our country. I keep on getting a lot of material from this association, and let me tell you, the quality of the material is excellent. In fact, I do make it a point whenever I get an opportunity, I go through the journals to see and understand what is happening. Grateful to Tarunji, my good friend, Shubhamji, Siddhantji, to all the seniors of the profession. So today's topic, we are going to deal with offenses and penalties. Let me say, it may be a coincidence, but we are starting a 10-day series with a topic wherein we are starting with the fact that the taxpayer has committed some offense, and now the department is trying to look at that offense, trying to understand what kind of power the law enables them to take action against that erring taxpayer. And as far as taxpayer is concerned, what kind of remedy the taxpayer has in terms of defending the case of penalty as well as prosecution. So that in a nutshell captures what actually happens at a practical level. Now to start with, just a second, let me just put the screen. Right. I hope it should be visible.
Yes, sir. It
So
is
friends,
visible.
okay, great. So friends, when we say offense and penalty, what I intend to do in next maybe 1.5 hours is first to take you through the overview of the provisions of the Act, because as I see it, the topic has much more relevance in terms of what the Act says, and vis-a-vis that, what kind of actions department can take under those provisions. And therefore, it's very important to first have an overview of the relevant law. Second, we look at certain important case laws that have come from especially the Supreme Court in the context of similar provisions that we had under the pre-GST era. Largely, we look at the provisions under the excise law and how the Supreme Court has interpreted certain expressions used in those provisions and how those interpretations would be relevant when it comes to interpreting the provisions under the GST law. We also look at certain decisions coming from the VAT law because there are certain important principles which have been laid down, which to my mind shall be very relevant when it comes to the adjudication of the demands related to penalties under this law. We look at also certain case laws relating to arrest and prosecution, because that is again part of penalties, a larger set of, we can say, a topic on penalties. So we look at those cases. There are certain interesting cases that have been rendered by the high courts in the GST context. So we look at those cases. And at the end, we look at certain important issues which are practical and certainly which are pending at various high courts, and we are waiting for those issues to get deliberated, to get decided upon. But understanding the issues would become relevant so that you can advise your client, the taxpayer, the kind of arguments, the kind of contentions that he can consider, placing it on record before the appropriate authority if he is facing such issues. At the end, as the moderator has already discussed, time permitting, it will certainly be a pleasure rather to take questions on the given topic. As I see it, it's a 10-day course, and as I see it, although provisions related to the violations of the provisions when it comes to transporting goods, which are there under section 129 of the CGST Act, will be dealt as a separate topic by itself. So I am not going to go into those issues because I think there is an entire session for on that subject. Similarly, when it comes to section 130, when it comes to confiscation, we will limit ourselves to confiscations which happens other than the confiscation that happens during the transit of goods, because that part of confiscation during the transit of goods would certainly be dealt by the respected speaker when the speaker takes that topic in detail. We are also not going to consider the provisions related to 73 and 74, that is in terms of issuance of show cause notices and adjudication of those notices. We'll only touch upon certain aspects of those provisions which are relevant to our topic, that is penalties. But the larger topic in terms of how show cause notice should have been framed, what kind of contentions one may take against such notices, what are the issues related to the limitations and all other aspects, that I think will be dealt with as a separate topic by itself. So with that caveat, we'll focus ourselves exclusively on the topic which has been allotted to me, that is offenses and penalties. And it is in this context that we will try and understand the law. So when we say offense and penalty, we need to first understand what these terms mean. Now, these terms have not been defined in the GST law. However, the term offense has been defined under Section 3, Clause 38 of the General Clauses Act. It says that it's an act or an omission which is made punishable by law for the time being in force. So when we say offense in our context, it is not an offense in a moral sense. It is an offense in a sense which is under a statute, where a statute formulated by the parliament specifies certain acts or certain omissions which a particular person, including a taxable person, ought not to have performed or ought to have performed in a certain manner, and that has been contravened, and therefore that act or omission has been made punishable in terms of penalties as well as prosecution in cases where that is permissible. So it is in this context that one has to understand the topic. At times, we often find that when the department seeks to impose penalty as part of the show cause notice, when you see those notices, apart from the merits of the case, when it comes to the justification for the imposition of punishment in terms of penalty, one often finds that the burden which should be discharged by the department is often not done so. Many times we find that the show cause notice fails to identify the particular act which is actually made punishable by the law, but tries to assume the certain acts and basis that tries to make a case to say that penalty is imposable. Therefore, one should always keep in mind that when one wants to address the issue related to penalty, one has to always understand that what is the exact act which has been made punishable by law, and whether in the given facts and circumstances of the case, whether your client has actually performed those acts, what were the situations or compelling reasons which made the taxpayer commit or do that act, and basis that, then one can see whether that act actually fits the act which has been stipulated by the parliament, which, if committed, can result in the imposition of penalties. So it is in that context that the word offense is to be understood. So please be very mindful of the fact that it is not that any and every act is punishable in law. Only an act stipulated in the law, formulated by the parliament, is punishable. And therefore, one has to always be careful when it comes to addressing issues related to penalties. The word penalty has not been defined again in the act, but as we discussed, it is basically a punishment for inflicting the violation of any law. Now, Chapter 19 of the CGST Act and the State GST Act deals with provisions related to penalties. It has sections running from section 122 to 138. These provisions are also made applicable under an act committed under the IGST Act, that is by virtue of section 20, clause 21, whereby said provisions say that as far as IGST Act is concerned, the provisions related to offences and penalties under the CGST Act would apply mutatis mutandis, and therefore all the provisions related to offence and penalty from 122 to 138 also becomes applicable if someone is committing an offence under the IGST Act. In fact, the proviso to the IGST Act under section 20 further provides that when the penalty is leviable under the CGST Act and the State GST Act, then the penalty which will be leviable under the IGST Act will be the sum total of the state penalties. So it is in a way saying that if a certain penalty is leviable under the CGST Act, then the penalty under the IGST Act would be double the penalty under the CGST Act. And it is for the reason that IGST Act is a central law, whereas state GST and center GST are state and central laws applying to intrastate supplies, whereas IGST applies to interstate supplies. Now, in this presentation, when we refer to the provisions, our reference would be to the CGST Act unless we discuss it otherwise. So let us now have a quick overview of the provisions that we have just discussed, and then we go into the issues. So section 122 is the provision which provides for imposition of penalty. It says that if a taxable person commits any of the stipulated offenses, which runs from clause Roman I to Roman 21. So in all, there are 21 offenses which have been stipulated, which if committed by a taxable person will result in the imposition of penalty. The quantum of penalty has been stipulated to be 10,000 rupees or the amount equivalent to the tax evaded or ITC wrongly claimed or refund erroneously availed, so on and so forth, whichever is higher. The section 22 also imposes the penalty on a person who retains the benefit of certain stipulated transactions. So law has provided that the transactions which are covered under clause 1, 2, 7 and 9 of subsection 1, if they are committed, then a person who retains the benefit of such transactions and at whose instance such transaction is conducted, that person also becomes liable for penalty. Again, the quantum of penalty would be either 10,000 rupees or the input tax credit availed of or passed on. Basically, these 4 clauses which have been referred in this particular provision 122, 1 capital A, are dealing with situations where a person undertakes the transactions in the nature of issuing fake invoices. It is in that context that this provision has been made to say that not only the person who is issuing the invoices, that is the registered taxpayer, but even a person at whose instance the transaction was undertaken and who has benefited from that transaction would also render himself liable for penal consequences. Then it says that it also provides for imposition of penalty in situations where either the tax has not been paid or short paid or erroneously refunded or ITC has been wrongly availed without any intention of suppression, misrepresentation or fraud. In that situation, it provides for penalty to the extent of 10,000 rupees or 10% of the tax due. And in cases involving evasion, it provides for imposition of penalty equal to 10,000 rupees of tax due. We'll see all of these aspects when we actually go and see the relevant provisions and issues a little later. Lastly, section 122 also provides for imposition of penalty on person who is aiding the commission of an offense or who is abating any of the commission of the offenses, or who acquires or consents with the goods which he knows or has reason to believe are liable for confiscation, or he receives or consents with a supply which he knows or has reason to believe is in contravention of the law, fails to appeal before the officer against someone, or fails to issue invoice in accordance with the law, or fails to account for any invoice, then in that situation, the penalty can extend to 25,000. Now let us look at the 21 particular clauses which are referred in subsection 1. So first and foremost, one has to understand that section 122 subsection 1 applies where a taxable person commits the stipulated offenses. The term taxable person has been defined in the law to mean a person who is registered as well as a person who is liable to be registered. So it is not the case that these provisions apply only to registered persons committing an offense. This provision also applies to a person who was otherwise liable for registration but has failed to take on the registration. Now, it is in this context First, let us see all the clauses. The way the clauses have been structured, all the 21 clauses, one will find that it starts from the gravest of offenses and gradually goes down and goes to the offenses which are not more serious or more grave. It is in that context that the 21 offenses have been listed. First offense which forms part of this 122.1 is that a person is supplying any goods or services without issue of invoice or issues an incorrect or false invoice with regard to any such supply. So he's basically supplying the goods without invoice. Clause 2 considers a situation where he issues an invoice without supply. So clause 1 considers situation where there is a physical act of supply happening without invoice. Clause 2 concerns with a situation where only invoice is being issued. Underlying supply of goods or services are not rendered, not provided. And it is in this context that if these two offenses are committed, then those are stipulated offenses under 122.1. Clause 3 deals with a situation where someone collects an amount as tax but does not pay the same to the government within a period of 3 months from the date on which such payment becomes due. So this is basically again a serious offense where a person is collecting something by saying to the recipient that this is a tax, but he is failing to pay that money to the government beyond 3 months from the date on which such payment becomes due. Such payment becomes due on the date when he receives it. So by the due date of the next, the return for that particular month, that is 20th of the next month, he is supposed to pay this money to the government. If he does not pay this money to the government, which he has collected representing as tax, then in that situation, he attracts penalty under clause 3 of section 122.1. Clause 4 deals with a situation where someone collects any tax in contravention of the act but fails to pay. This is in the context of TCS, where someone is actually collecting the tax. This is in the context of e-commerce operators where they are supposed to collect the tax. It is in this context that if someone collects the tax but he does not remit to the government within 3 months, in that situation, again, he is said to have committed an offense under clause 4. Clause 5 deals with a situation of TDS, where, as you are aware, under the GST law, under section 51, there are provisions where certain entities are made liable to deduct tax at source. So in a situation where such entity deducts the tax at source but does not pay it to the government, then in that situation, again, that entity can be said to have violated the provisions of law. And therefore, in that situation, under clause 5, that entity may also attract penalty. Clause 6 deals with a situation of tax, of failing to collect the tax at source. So this is a situation where he does not collect or he collects but makes a short collection. So as you can see, what we understood up till now, the first 5 offenses were of serious nature, in a sense that all those offenses results into a loss of revenue with a clear intent to defraud the government, because in all those situations, as you can see, a person is actually not making a supply, issuing invoice, not making a supply, collecting the amount as tax, but not paying that money to the government, collecting TCS from the customer, not paying that to the government, deducting TDS, not paying to the government. So these are the offenses where someone has clearly benefited unjustly, and therefore those offenses stand at a higher pedestal. Then these are the offenses, the second list of offenses we can say, where the offenses are still offenses, but not of higher pedestal. And why I'm making this distinction, because when we go to section 132, when we realize this distinction, that the offenses which we discussed, the first 4 offenses that we already discussed, if one commits those offenses, then not only the person renders himself liable for penal consequences, but then there are provisions related to prosecution that one has to face, where the given offenses, the 4 offenses that we have discussed, are at a higher pedestal, where the offenses are made cognizable and non-billable, and therefore that has far severe consequences as compared to consequences that one may have to face if one commits other second set of offenses which are not of much seriousness when it comes to invocation of section 132. We will see all those aspects also when we go to 132 and try and correlate that with 122. Clause 7 deals with a situation when someone takes or utilizes input tax credit without actual receipt of goods in contravention of the provisions of the Act. So again, it's a grave offense where someone is availing the credit without actually receiving the goods. Clause 8 deals with a situation where someone fraudulently obtains the refund. Clause 9 deals with a situation where someone takes or distributes the credit in contravention of the section 20, which deals with the provisions related to input service distributor. 10 deals with a situation where someone falsifies or substitutes the financial records or produces fake records, fake accounts with an intention to evade the payment of tax. 11 deals with a situation where someone is liable to be registered but fails to obtain the registration. 12 deals with a situation where someone furnishes false information with regard to registration particulars, either at the time of applying the registration or subsequently, that is, at the time of modification. 13 deals with a situation where someone obstructs or prevents any officer in discharge of their duties under this Act. 14 deals with a situation where someone transports any taxable goods without the cover of documents as specified in this behalf. 15 deals with a situation where someone suppresses the turnover leading to the evasion of tax. 16 deals with a situation where someone fails to keep or maintain or retain the books of accounts or other documents which are required in accordance with the law. 17 deals with a situation where someone fails to furnish the information which is called by the officer. 18 deals with a situation where someone supplies or transports or stores any goods where he has a reason to believe that those goods are liable for confiscation. 19 deals with a situation where someone issues an invoice by using the registration number of some other registered person. 20 deals with a situation where someone tampers or destroys any evidence or document. And 21 deals with a situation where someone disposes of or tampers with any goods that have been detained, seized, or attached under the provisions of this Act. So, friends, as you can see, these are the 21 list of offenses which, if someone commits, then that person becomes liable for penal consequences. As you can see, all these 21 offenses are distinct. All these 21 offenses has different set of facts which are required to be established for the offense to be said to have been committed. And only thereafter the penal consequences can be attracted. Each clause is specific. So at this stage, one should keep in mind that whenever someone faces an action where proceedings are initiated and penalties sought to be imposed under 122(1), one has to understand first and foremost from the show cause notice as to under which clause the penalty sought to be imposed. Basis that, one has to see whether in the given factual situation, whether the concerned taxable person has actually committed that action which is stipulated in that clause. And if the answer to that is no, then to my mind, no order confirming the penalty can be passed. As you are aware, and you will see this point also when you deal with a situation on adjudication, that show cause notice is the foundation for any proceeding. So if a show cause notice has been initiated saying that you have committed offense under clause, let us say 21, then the facts should support that allegation. And if the facts are that no, you have not committed any offense under clause 21, even though those facts may support a view that you might have committed an offense under clause 20, but that does not give any liberty to the adjudicating authority to confirm the demand of penalty under clause 20. The adjudicating authority has to then decide only under clause 21 as to whether the given facts fit into that situation. And if the answer to that is no, then the adjudicating authority is required to drop the demand of penalty. The adjudicating authority then cannot confirm that penalty. These are all classic principles. We will see also later when we go to the decisions of the Supreme Court, where all these aspects will become very evident. Now, when we look at 122.1, what we discussed, how much is the quantum of penalty under 122.1 if you commit any of the 21 stipulated offense. Then you attract the or the refund claim fraudulently, whichever is higher. So in a way, situations, the net result of 122.1a is a provision which was inserted by Finance Act 2020, which came to effect from 1st January 21, which says that the offenses referred in clause 1 to 7 and 9, these are all offenses related to fake invoicing, where goods are supplied, invoice is not issued, invoice is given to someone else, invoice is given, goods are not supplied, ITC is taken without under receiving the goods underlying that particular invoice. So in these situations, a person who is going to retain the benefit of that transaction and at whose instance the transaction has been conducted also becomes liable for penal consequences. Now, why this was made? This was made basically to cover a situation where the government realized that in a lot of these fake billing cases, the person who is on record is normally a person with either very meager means or no means, because registrations are obtained by the evaders in the name of their housemates, in the name of their drivers, in the name of their workers who may not be aware about the crime which is being committed on the basis of their documents, but on paper it is the registrations are obtained in the name of this kind of persons. Invoices are issued from those registrations, and ultimately when the authorities find that the transactions were not genuine, they take action against those persons, but those persons certainly are not the real culprits, the real evaders, and therefore a need was felt that a separate provision was required to enable the imposition of penalty on the person who is the ultimate beneficiary of the transaction and at whose instance the entire transaction was conducted. So if department can establish that it is not person A who is the registered person who has only committed the offense, for committing an offense by Mr. A, Mr. B was the real kingpin. It was Mr. B at whose instance Mr. A gave his documents, basis which registration was obtained, basis which the fake invoices were issued. And therefore, Mr. B also then becomes liable for penalty under this new clause 1 capital A to section 122. Please understand, this amendment comes into effect only from 1st January 21. It's a subtle principle of law that when it comes to imposing penalty, the relevant law on the date on which that act that results into the imposition of penalty is committed will apply. So if someone commits an act prior to 1st January 21, basis that act, if a proceeding has been initiated, to my mind, proceeding can be initiated only under 122.1 for imposing penalty under those provisions. 122.1a will not be available to the department for the reason that it was not in existence when the actual act was undertaken, when the actual act of making a supply, of making an invoice without underlying supply was undertaken, and therefore, in that context, one can very well say that a penalty may not be imposable under 1A. Only one will be available to the department to to impose penalty against such persons. But of course, after 1st January 21, if someone commits an offense, certainly not only the committer, but even the person who is the beneficiary and and at whose instance that offense was committed also becomes liable for penal consequences. Now, 122.2 also imposes penalty, but here the difference is 122.1, as we discussed, provides for imposition of penalty when an offense is committed by a taxable person. Taxable person, as we discussed, includes a person who is registered and as well as a person who is liable to be registered. On the other hand, 122.2 imposes penalty only on a registered person. It says that when a registered person commits the offense, which kind of offense? Who makes a supply where tax has not been paid or short paid or erroneously refunded, or where ITC has been wrongly availed or utilized. In that situation, 122.2 provides for imposition of penalty. If that act is committed for reasons other than fraud, then the quantum of penalty would be 10,000 or 10% of tax dues. And if that act is committed by reason of fraud, then in that situation, the quantum of penalty would be to the extent of the tax due from such person. Now, at this stage, one must keep in mind that there is a clear demarcation between what is an offense under 122.1 and what is an offense under 122.2. As you can see, let us say if someone has taken a credit where department is alleging that that credit has been taken based on an invoice which is not genuine, which is a fake invoice, and therefore the credit is not eligible. If that is the allegation of the department, then as one can see, that act of availing the credit without receiving the underlying supply of goods or services is a offense which has been prescribed under 122.1. In that situation, to my mind, 122.2 cannot apply because 122.2 first does not consider such offense. Second, 122.1 being a special provision shall override the provision which is more general in nature under subsection 2. So this again, why this is again relevant? This is relevant because one has to see under which provision the department is seeking to impose penalty. If in such situations, if department is relying on 122.2, one can certainly say that this is not an offense covered under 122.2 for the reason that this is an offense not prescribed under 122.2. 122.2, when it talks about ITC wrongly availed or utilized, it is in a situation other than covered under 122.1. That is in a situation where the genuineness is not disputed, but the claim of ITC is disputed on other grounds. It is in that situation that 122.2 may become applicable. 122.1 specifically becomes applicable when the allegation is that the ITC has been availed based on the strength of a fraudulent or a fake invoice. So this distinction one has to keep in mind. Even on the outward side, one has to see 122.2 says that someone is actually supplying the goods. A registered person is actually supplying the goods. But what is an offense? The offense is that either he has not paid the tax or he has short paid the tax. So this is again a limited situation where the act of supply is not disputed. What is disputed is that in pursuant to that supply, either tax was not paid or tax was short paid. So again, this is something which is clearly distinct from what we saw in 122.1, where the nature of offense listed in that provision says that one either does not make a supply and only issues an invoice, or he issues just an invoice without supply or supply without invoice. So again, something which is not under 122.2, specifically under 122.1. On both the sides, one can find that there is a distinction between situations under subsection 1, where penalty is imposable, and under subsection 2, and therefore, if department is seeking to impose the penalty for the act committed by the taxpayer, then department ought to identify which is that particular act which has been committed, and then ought to refer to the correct provision of law to allege that such person should be liable for penalty. Subsection 3 deals with the persons who are abettors or who assist the commission of the offences from clause 1 to 21 of subsection 1. It even includes those persons who are acquiring or dealing with the goods which they know are liable to confiscation. When we talk about confiscation, we refer to section 130, where it gives certain situations where if someone commits an offense, then the goods thereto are become liable for confiscation. C talks about situation where someone someone is concerned with a supply where he has reason to believe that the supply of service is happening in contravention of the provisions of the act. So these are again attracted only if the department is able to establish that the person had the knowledge that either those goods are liable for confiscation or had the knowledge that the supply of services was happening in violation of the provisions of the law. Only in that situation, that person who is not the actual recipient of goods or services, who is just concerning with the supply of the said goods or services, also becomes liable for penalty. Maximum amount is only 25,000. D talks about situation where someone fails to appear before the officer. So when a summon is issued and someone does not appear or does not produce a document, again, that act can attract this 25,000 penalty. And E considers a situation where he does not issue an invoice which he is otherwise required to issue under this act. In that situation also, that person attracts penalty. The penalty is not a fixed sum. As you can see, it can extend to 25,000. So a discretion has been vested by the parliament at the hands of the officer. So basis the facts of a particular case, that officer has to decide how much amount of penalty he wants to impose under subsection 3. Of course, the maximum amount shall be 25,000 rupees. At this stage, it is important to understand. So what we have already discussed is section 122 and the penalty is imposable under that provision. Now there is a scheme under the law whereby one can avoid penalty. So this is in contradiction to the other issues that we are going to see a little later, where one wants to contest the penalty. So I thought it is fit that we discuss this also as part of this topic, that there is a scheme available in law whereby one can seek either complete waiver of penalty or a partial waiver of penalty. That is, of course, subject to the fact that the person admits the liability, whatever is the arrears liability, and therefore in that context agrees to pay tax and interest in a situation covered under section 73. That is, in a situation where department is not alleging evasion. In those situations, the scheme says that if you make the payment of tax and interest before issuance of notice, or even within 30 days of issuance of notice, in both these situations, no penalty is required to be paid. The case would, on its own, the proceedings would get abated. In a situation under 74, that is in a situation where department is alleging evasion, which in most number of cases is the reality. In that situation, the law says that if someone pays over and above tax and interest, penalty equal to 15% of the tax, then the balance 85% can be saved, provided this payment is made before the issuance of show cause notice. If the person makes the payment within 30 days of the issuance of show cause notice, then under section 74(8), the quantum of penalty would get enhanced by 10 more percent. So instead of earlier, where he could have paid 15% and he could have closed the proceeding, in this situation, he will have to pay 25%, and accordingly, the proceedings will get concluded. If, let us say, after show cause notice, 30 days are over, and still the person has not made the due payment of tax and interest. In that situation, the law still says and gives the last kind of opportunity to say that under Section 73, you can pay tax, interest, and penalty. Under 73, as you are aware, maximum penalty imposable is anyway up to 10% of the tax or 10,000 rupees, whichever is higher. So that is the quantum that you need to pay. If you pay that amount, then in any case, the recovery would end. In case of 74, the law provides that within 30 days from the communication of the order, if you are willing to pay tax, interest, and penalty equal to 50% of the tax, then in that situation, the proceeding would abate. So these are basically the provisions where one has to be conscious, one has to be aware enough to understand that if someone is intending to contest only the demands of penalty, then one has to be very much aware that he has a good case. The reason is this, that if you lose on merits, if you find that your case on merits is weak, and therefore you still you are intending to litigate, then in that situation, not only will you be exposing yourself to a greater interest liability as time progresses till you get a final verdict, but you are also exposing yourself to full penalty, because this option of closing the proceeding by paying 15% or 25%, or for that matter even 50%, will not be available after 30 days from the communication of the recovery order. So one has to keep this in mind. I'm not saying that this scheme must be exercised. In fact, in most number of cases, you will find that you have an excellent case, and therefore you may not have to, in fact, go and exercise this scheme. But in certain situations, considering the facts of the case, considering the appetite of the taxpayer in terms of facing litigation, one may then consider this taking an action under this particular provisions to kind of close the matter. Be very careful, because under 74, option of paying 15% is available only before, if the payment is made before the issuance of show cause notice, and thereby you basically save 85% of tax as penalty. So in any case, if someone is intending to opt for this scheme, it is better to opt before show cause notice. It doesn't make sense that you opt after you get the order, because in that situation, instead of losing the matter at 15%, by paying penalty equal to 15%, you will end up paying penalty equal to 50%. So in a way, you will end up paying 35% of tax, a higher penalty, if ultimately after receipt of the order, you decide to close the case. Why I'm saying this is again for the reason that, look, when a client comes to you, he is coming to you with the facts, he is coming to you with the proposed allegations of the department, basis the audit or search or summons conducted by the department, and considering all this evidence, considering the applicable law, a professional judgment should be made as to whether is it really advisable to opt for this scheme. If yes, better to opt at the earliest to save further cost. And in a way, if you end up with a conclusion that no, the client has a very good case, then in that situation, the scheme is totally to be ignored. And in that situation, you participate in the adjudication, you participate in the further proceedings if required, and accordingly the case would get finally decided. But this scheme is something that you should keep in mind, and this should be kept in mind as early as possible when the issue is picked up, issue is discussed, facts related to that issues are there on record. It is at that stage that this decision is required to be taken. Again, there is a provision of double jeopardy under 75 clause 13, where it says that if the penalty is imposed under 73 or 74, then no penalty for the same act shall be imposed under any other provisions of this act. Now, this was required for the reason that, as you are aware, under 73 or 74 also, there is a provision which says that along with the show cause notice, not only the recovery of tax or ITC or refund would be made, but that recovery would be with interest and penalty. Under 73, it is 10% of tax. Under 74, it is equal to the tax evaded. So it is in that situation that if the penalty already stands imposed by virtue of those proceedings, then for the same act, again penalty cannot be imposed under section 122. So it is for that reason that clause 13 of 75 makes it expressly clear that double penalty should not be imposed for the same act. Now, from the scheme, what is excluded? From the scheme, what is excluded is prosecution. So if someone says that, okay, under the scheme, if I go and if I pay the reduced penalty, can I save all liability? The answer would be no, only to the extent of balance penalty amount, the recovery would not happen. But a client will still have to face action under 132, that is under prosecution, if that particular case fits into those relevant provisions. Core notice, now when someone wants to opt for the scheme of seeking the full or partial waiver of penalty, then in that situation, the explanation to section 74 is trying to suggest that in that situation, if the proceeding against the main person are concluded on the basis that he has agreed to make the payment of tax, interest, and reduced penalty, then proceedings against all other persons, that is co-notices, are also deemed to be concluded. So if the main noticee agrees to pay that amount of reduced penalty, in that situation, not only the balance penalty is saved, but even the penalty which is imposable under the co-noticee. Under the co-noticee could be the directors of the company, where the department alleges that they are the abettors. They also aided in the commission of an offense by the company, and therefore they are also liable for penalty. In those situations, if the company agrees to settle the case under the scheme what we have discussed, in that situation, even the proceedings against the other notices in the same matter would also stand concluded. So no penalty would be required to be paid by other notices in such situations. Now, new section, subsection 1, capital B has been inserted under section 122. This is yet to take effect, but this is basically relevant for e-commerce operator, where now what the law seeks to say that if an e-commerce operator is allowing the supply through it by an unregistered person other than the person who is exempted from registration, or the e-commerce operator is allowing interstate supply by a person who is not liable to make interstate supply, as you are aware, under the composition scheme, a person cannot make an interstate supply. So if someone is under the composition scheme but makes an interstate supply through an e-commerce operator, then that person is violating the provisions of the scheme. So not only the action would be taken against that person who has violated the provisions of the composition scheme, but even against the e-commerce operator who allowed such supply, knowing that such person is otherwise not liable to make such interstate supply. Or the e-commerce operator fails to furnish the correct details when it comes to a statement which is required to be given by it in terms of the supplies which have been effected through it by the persons who are exempted from obtaining registration. Then in that situation, the e-commerce operator, if commits any of these three offenses, becomes liable for penalty, which is again equal to 10,000 rupees or the amount of tax involved had such supply been made by the registered person other than person paying under section 10, whichever is higher. Now, this is draconian provision, because an e-commerce operator, if let us say, is allowing thousands of suppliers to make supplies through it, and if some of the suppliers are actually making interstate supply, being under the composition scheme, which the law does not permit, and in that situation, the e-commerce operator becomes liable to pay penalty equal to the regular tax, which is imposable on supplies made by all such suppliers who are unlawfully or illegally claiming the benefit of composition scheme. So you can imagine, not only the action will be taken against the composition supplier who has actually violated the law, but action also would be taken against the e-commerce operator. And hefty penalty has been proposed in such situation. Now, this is an amendment which is yet to take into effect, although it is now part of the law by virtue of Section 155 of the Finance Act 2023, but the same is yet to come into operation. Now, 127 deals with situation where there is a power given to the officer to impose a penalty where a person who is liable, liable to penalty is not covered under 62, 63, 64, 73, 74, 129 or 130. Now, this is a very important provision. See, why this is important? Because let us take a case. Let us take a case where someone has actually availed fraudulent credit. Now, if a situation is like this, that he has availed fraudulent credit on a fake invoice, and he has consumed those credit, and he is, let us say, on the outer side, making a genuine supply of goods or services, and in that situation, the recovery which is required to be made from such person, as per, in fact, the board's own circular is this, that input tax credit will have to be recovered along with interest and penalty. So in that situation, the department will invoke Section 74 to say that we will recover the wrongly availed credit, interest on that credit if it has been utilized, and penalty equal to the wrongly availed credit. But let us take a case where someone has taken such fake credit and passed on such fake credit. So department is saying that your inward and outward, both supplies are fake. You have just engaged in billing activity where you have created this dummy firm, where you have taken the invoice and you have issued the invoices. In that situation, the circular says that only penalty can be recovered from such a person, because this is a person who has actually not received any goods nor supplied any goods. So question of recovery of tax does not arise. Whatever ITC that he has availed, he has already reversed when he make a fraudulent outward supply. See, so in any case, recovery of tax is not permissible. And therefore, the circular says that in such situation, only penalty can be imposed under Section 122 on such person for committing such offense. Now, if that is the case, then order for recovering penalty against such person cannot be issued under Section 74. It is Section 127 under which the order is required to be issued. Now, this is very significant because we have found in our practice that in many cases we see a department issuing notices for recovering penalty under Section 74(1), when actually the case is that tax and interest cannot be recovered. At the most, only penalty could have been recovered. And in that situation, the proceedings cannot be initiated under Section 74. The proceedings ought to have been undertaken under Section 127. So in a situation where 127 is not invoked, where it is actually invocable, and in that situation, one can say that those proceedings are non-est, they are not good in law. So it is in that context that 127 is very, very important. 128 grants the power to the government to waive in full or part any penalty which is imposable under 122, 123, 125 or late fee under 47. It is by virtue of this provision that government issues notification either completely waiving late fee or partially waiving the late fees. 129 deals with the situation of detention, seizure and release of goods and conveyance during transit. 130 deals with situation related to confiscation of goods or conveyance and levy of penalty. As we discussed initially, I'm not going to deal with 129 at length because there is an entire session planned for 129. 130 will deal only with the issues related to confiscation happening otherwise than in transit. 131 deals with a situation where it provides for the imposition of penalty, where it in a way says that if a penalty has been imposed or a confiscation has happened, that shall not prevent the infliction of any other punishment under the GST law. So in a way, 131 says that imposition of penalty under 122 or confiscation of goods under 130 will not be the end of the consequences. If there is a punishment which can be inflicted under any other law, then that would still survive. That would not get action under those law can still be taken by the concerned authorities. 132 deals with a situation where it provides for punishment. Now there are total 11 offenses from clause A to I, which are covered under 132.1. The offenses are broadly classified into non-cognizable and bailable and cognizable and non-bailable offenses. Which are those offenses under 132.1? So again, similar to the structure of 122.1, it says that whoever commits an offense starts with a grave offense and then gradually comes down with offenses which are of lesser severity. So it says that whoever commits or causes to commit and retains the benefit arising of any of the following offenses. So language is very broad. Not only the committer of an offense, but a person who is retaining the benefit also becomes liable for action under 132. 132.1a says that a person is supplying the goods without invoice. B, issues an invoice without underlying supply, or wrongly avails or utilizes the ITC or claims refund of tax, avails the ITC based on a fake bill, which is referred in clause B, collects an amount as tax but does not pay the same to the government, or evades the tax or fraudulently claims refund, where such offenses are not covered under clause A to D. F, falsifies or substitutes the financial records. G, obstructs or prevents any officer in discharge of his duties. Now, this offense, by virtue of Finance Act 2023, is now thought to be omitted. Still, this amendment has not come into effect. However, basically, it's a trivial offense is of a trivial nature, and therefore, Parliament in the last Finance Act thought it fit to omit it from the list of offenses inviting prosecution. H deals with a situation where someone concerns with the goods which are liable for confiscation. I deals with a situation where someone deals with the supply of services where such supply has happened in violation of the law. J deals with a situation where someone tampers with evidence. Again, this is thought to be now deleted from law in terms of attracting prosecution. Again, this is an amendment which has happened through Finance Act 23. K, again, a trivial offense sought to be now deleted, where he fails to supply the information which is required by the authorities from time to time. And L, any attempts to commit or abates the commission of any of the offenses in clause A to F and H and I. So not only the commission of an offense attracts prosecution and punishment, but even an attempt to commit that offense or an abater to that offense also attracts prosecution and punishment under section 132.1. What is the quantum of punishment under 132.1? It is based on the amount involved. So if the amount is more than 5 crore, then the punishment would be imprisonment for a term which may extend to 5 years and fine. If the offense is between 2 crore to 5 crore, imprisonment could be up to 3 years and fine. And in all other offenses, it would be 1.5 above 1.5 crore. Then the imprisonment could be up to 1 year and fine. Now here one amendment has been made through the last Finance Act, whereby since all trivial offenses are now deleted, an amendment has been made to say that only an offense committed in clause B, that is an offense of issuing a fake invoice, if that offense is committed, then the 132, that is prosecution and punishment, will be attracted if that amount is above 1 crore. So in a way, as you can see, the minimum threshold for attracting 132 punishment is now brought down to 2 crores. But if an offense referred in clause B, that is offense of issuing a fake invoice, if that offense is committed, then the threshold of 2 crore will be still brought lower to 1 crore. So the lower threshold of 1 crore applies only to an offense of issuing fake invoice. For all other offenses, the threshold of 2 crore will apply. Between 2 to 5, the punishment would be up to 3 years with fine. And above 5, the punishment would be 5 years with fine. The offense under 132(1), A, B, C, D, those are offenses which are cognizable and non-bailable. Cognizable would mean that the punishment can be meted to the committer of that offense only only when the cognizance is taken by the magistrate under the provisions of the criminal procedure code. So only it is in that context that because it's an offense of a higher severity, so unless it is unless the prosecution happens in terms of the provisions given under the law, in that situation only the offense would become cognizable. Non-bailable means that automatic bail would not be available when an offense is committed and the person is arrested. In that situation, it is the magistrate or the higher courts would be in a position either under the Article 226, Article 32, or under the provisions of CRPC. That is when they will be able to grant a release or a bail to such person. In case of a non-cognizable and a bailable offense, the warrant from a magistrate is not required. At the same time, that person can seek automatic bail on the payment of the applicable bail bond along with surety. So that is how the law has tried to demarcate the offenses into two categories. Offenses where where the amount involved is more than 5 crore, of course, attracts higher rigors and higher punishment. Now, already we have seen this. Yeah. See, all this punishment under section 132 requires the sanction of the commissioner. So, a commissioner has to sanction the prosecution. Basis that a charge sheet will have to be filed with the concerned authority, and basis that the proceedings will have to be undertaken. 133 deals with a situation where punishment is to a person, including the officer, who discloses the information which he has obtained under the law. 134 deals with a situation where, as we already discussed, when can the court take cognizance of an offense? We already discussed cognizable offenses. The court will take cognizance. For non-cognizable offense, the court is not required to take cognizance. Bail is automatically available on the payment of the applicable surety amount. 135 deals with the presumption of a culpable mental state in a prosecution. So when a prosecution is initiated against an offender, in that situation, section 135 says that the court shall presume that there is a existence of a culpable mental state, and it is on the accused to prove before the court that the act was committed without the culpable mental state, that is, without any intention to evade the law. 136 deals with a situation where the law says that if a statement has been recorded under section 70 against the summons, then that would be considered as an admissible evidence for prosecution and for proving the truth of that statement unless the person who has given that statement is incapable, that is either he is dead or he is not able to come as a witness, or he coming as a witness will delay the proceeding, the prosecution proceeding, or the expense that will be incurred for bringing that witness, which the court considers to be unreasonable. In all these situations, the law says that the statement given by such person would be considered as true. Alternately, a person who has made the statement, so in a situation where the above clause is not applicable, in that situation, the person who has made the statement will have to be examined as a witness. Basis that, the court will have to then see whether the contents of that statement are to be considered as truth for the purpose of meeting the punishment. 137 talks about imposition of punishment on the persons who are in charge of company, firm, LLP, HUF, trust. So these are all the directors, partners, employees, partners, limited liability partners, Karta, members of the HUF, members of the trust. So again, these are also the persons who are made liable for punishment. However, the person can exclude himself from the punishment if the person is able to satisfy that the offense was committed without his knowledge, or that he had exercised all the due diligence to prevent the commissioning of such an offense. So if this two fact, either of these two facts, if it can be established, then in that situation, that person would not be then liable for punishment under 137. Otherwise, department may also initiate punishment against the persons who are in charge of the of such taxpayers. 138. This is the last section in our topic, deals with the compounding of offenses. It basically says that if you have committed certain offenses, then on payment of certain compounding fees, you can basically abate or put an end to prosecution. As per the existing provision, the quantum of fee is very high. As you can see, the quantum of fee that you need to pay is at the discretion of the commissioner, but it ranges from minimum 50% of the tax involved to 150% of the tax involved. Now, this Finance Act 2003 has made an amendment to this quantum, where now the quantum is sought to be brought down to minimum to be of 25% of tax and maximum to be 100% of tax. Again, these are the provisions which have not yet been notified. So it is only when it is notified that one can take the, this will come into effect. Rule 132, 162 deals with the procedure for the compounding of the offenses. So friends, this basically brings us to an important dimension of our discussion. These are the important decisions of the pre-GST era, which to my mind are very much relevant as far as GST law is concerned. Now, decisions span across various laws, but one thing which you will find common in all these decisions is that these decisions have been rendered in the context of a language which is similar to the language what we have in section 74(1). Why I'm saying this? Because most of the disputes related to penalty will happen under section 74(1). Now, when you look at section 74(1), all the acts listed in section 74(1) are required to be understood carefully, because if a particular taxpayer has undertaken an act which department is alleging to be under section 74(1), then it is necessary that it is established that it is coming within the parameters stipulated under section 74(1). Now, what does section 74(1) say? It says that where it appears to the officer that any tax has not been paid or short paid or erroneously refunded, or where ITC has been wrongly availed or utilized by reason of fraud or any willful misstatement or suppression of fact to evade tax. So, three situations have been envisaged under section 74(1). So, either by reason of fraud, the non-payment or short payment or wrong availment of credit or refund has happened, or by reason of willful misstatement. So not a simple misstatement. A misstatement knowing that it is incorrect, it is wrong, it is willfully done. That is a willful misstatement, or suppression of fact, and not just suppression of fact with an intent to evade the tax. It is in this situation, these three situations, that the penalty can be imposed under section 74(1). So now with this background, let us quickly look at some very important decisions and ratios of those decisions which we can apply in our context. The first important decision, not related to taxing statute, but very important when it comes to underlying the and how recently Supreme Court has disturbed this principle. Now, when it comes to penalty, whatever be the provision, what we all discussed, 73, 74, 122, mens rea is an essential ingredient by default. This is what Supreme Court held way back in 1966. Supreme Court takes a view that mens rea is an essential ingredient for any criminal offense. It extends that also to an offenses under of other nature, even civil offense. It says in this decision that unless the parliament statutorily in a civil nature, in a situation involving a civil offense, parliament expressly excludes the element of mens rea, the court says then mens rea will then have to be read into the law, and therefore whenever the word penalty has been mentioned, in that situation it would be essential to establish that the act leading to the imposition of penalty has been conducted with an intent to evade the payment of tax. So that was the line of first line of decision that came from Supreme Court, saying that ordinarily in a criminal statute, mens rea is by default has to be present in an act for it to attract a penalty or punishment. But even in a civil statute, unless the law expressly says that mens rea is not essential, in that situation, the mens rea will have to be read into the law. Now, this decision was recently kind of overturned in the case of Saw Pipes Limited. Now, this is a Supreme Court decision. In the Saw Pipes Limited, the issue revolved around the interpretation of Section 45(6) of the GVAT Act, the Gujarat Value Added Tax Act. In that situation, that provision states that whenever the assessed tax and the return tax, if there is a difference of more than 25%, then penalty equal to the differential tax will have to be imposed. In that situation, High Court took a view that unless that differential tax was not paid by reason of evasion, penalty under Section 45(6) would not be imposable. Supreme Court reverses that decision and says that no, under the fiscal law, penalty can be attracted even without mens rea if the language of the law allowing the imposition of penalty is silent on the aspect of mens rea. So this is completely different from what the Supreme Court held in 1966. In 1966, the Supreme Court takes a view that unless Parliament specifically excludes mens rea, even if mens rea is expressly not indicated in the language, still penalty cannot be imposed. Now in 2023, Supreme Court takes a view that no, unless mens rea is specifically indicated in the provision, then only that will have to be satisfied. If mens rea has not been indicated in the provision, then in that situation, their reading of the provision will have to be upheld. And in that situation, consequences in terms of penalty flowing from that provision will have to be upheld. Supreme Court relies on all the recent decisions that have come in some similar context where the courts have started taking a view that in a fiscal statute, whether mens rea is essential for imposition of penalty will have to be considered from the language employed in the law. Unless that language employed contains an element of mens rea is not essential for the imposition of penalty. So as we saw under section 74(1), mens rea is very much essential because all the three terms indicated under section 74(1), that is fraud, willful misstatement, and suppression of fact to evade tax. All the three phrases are indicating presence of a guilty intention. However, when it comes to 73(1), there the language is different because 73(1) expressly does not apply in situations of fraud or willful misstatement or suppression. 73(1) applies in all other situations, but still it provides for imposition of penalty equal to 10% of the tax evaded. Now, considering these recent views of the court, where they are saying that even if mens rea element is not expressly stated in the law, and in that situation, the penalty can still be imposed. It may happen that under section 73(1), even if the non-payment or short payment was without any intention of evading the tax, still one may have to face consequences in terms of imposition of penalty equal to 10% of the tax evaded. Now, another important decision that I wanted to discuss is in the case of Rajasthan spinning and weaving mills. Again, this is a decision that basically settled a lot of apprehensions that were there from the decision of Dharmendra Textile. In Dharmendra Textile, Supreme Court takes a view that if a penalty is imposable under the fiscal statute, then there is, and if let us say that penalty is a fixed amount, then there is no scope of discretion given to the officer to lower that amount. Department started interpreting this decision as if it gave a blanket right to the department to impose penalty in every and any situation involving short payment or non-payment or wrong availment of credit. Supreme Court later clarified in Rajasthan spinning that no, in Dharmendra's Textile, it was never the case that penalty can be imposed in any situation. Imposition of penalty still requires the officer to discharge the burden given in law in terms of saying that why that particular situation tantamounts to fraud, why that particular situation tantamounts to willful misstatement, why that particular situation tantamounts to suppression with an intention to evade. Only if that burden is satisfied, only in that situation penalty is impossible. But then Supreme Court says that once that is satisfied, and if the Parliament says that in that situation the quantum of penalty will be equal to the tax involved, then that officer is given no discretion to lower the amount of penalty, then the amount of penalty would be equal to what is stipulated in the statute. Now, another decision, now these are all landmark decisions where the courts have interpreted these three terms: fraud, willful misstatement, and suppression of fact. Now, what the courts are saying, if you see the decision of Kemper Trucks, the courts are saying that all these three terms require something positive. Mere inaction or failure on the part of the manufacturer or producer, or a conscious or deliberate withholding of information when the manufacturing otherwise is required before it is settled with any liability. This is very important. See, department will have to demonstrate through their show-cause notice where they make an allegation against the taxpayer that taxpayer committed some positive act. Mere inaction or failure on the part of the taxpayer, or in absence of any evidence to say that there was a deliberate and a conscious attempt of withholding the information, it cannot be said that the non-payment was on account of fraud or willful misstatement or suppression of fact. Now, many times we find department just writes in the show-cause notice that it is only because of audit or because of our proceeding that this came to light, that this amount was not paid or short paid or this ITC was wrongly aware. To my mind, that is not sufficient for the department to say that this is fraud or this is willful misstatement or this is suppression to evade the payment of tax. If the transaction is recorded transaction, if the transaction is part of your audited financial statements or your books of accounts, if the transactions pertaining to that period, if the report is given to some other government authorities, may not be GST department, maybe some other government authorities, and one cannot say that the taxpayer has committed that offense of committing a fraud or a willful misstatement or suppression with an intent to evade, unless department is able to bring on record something positive or some positive act of the taxpayer in this regard. In Padmini products, again, the Supreme Court says that in this situation, they are saying that, look, merely not taking registration is not enough. In this situation, in this case, the issue was that this petitioner had not taken the registration on some consideration of law, where they came to a conclusion that registration is not warranted. Ultimately, it was found that registration was required. Revenue takes a view in this situation that, look, whatever you didn't pay in the past was on account of fraud, and therefore you are also required to pay penalty. Supreme Court takes a view that no, this is not at all sufficient. What is required to be brought on record is that not just failure or negligence on the part of manufacturer, either to take out registration, but to bring on record a positive act to say that deliberately the information was withheld, deliberately the information was suppressed, and therefore the registration was not obtained. Cosmic dye chem, here again the court reiterates the word. They said, look, this word willful before the word misstatement or suppression clearly indicates that not every non-disclosure is suppression. Department says that you look at the definition of suppression under section 74. It says suppression means you are not providing an information which you are supposed to provide. Let us even assume that that definition is correct. Even then, for attracting the penalty under 74(1) or 122(2), it not only requires suppression, but it requires willful suppression to evade the tax. So, person should be conscious enough of knowing that he is purposefully not diverging this detail to any authority, trying to positively take an action of hiding those facts. And if that is available on record, then the department can say that this is a case of willful misstatement or suppression with an intent to evade, and that would then result in the imposition of penalty. So again, the importance of the word willful and the importance of the word intent to evade has been brought out by the Supreme Court in this decision. Ratio of this decision would squarely also apply in our context. In Tamil Nadu Housing Board, again, something important was brought out. Now, what this provision are trying to say? It says that the ordinary limitation period in this particular case was 6 months. Extended period of 5 years is available only if the situation falls in this ambit of fraud. In our situation also, ordinary limitation period of 3 years under 73 and higher limitation period of 5 years under 74. I mean, this case, Supreme Court comes with a very important ratio where it says that the initial burden is on the department to prove that the situations visualized by the proviso existed. Once the department is able to bring on record material to show that the appellant was guilty of any of those situations which are visualized by the section, the burden shifts, and then applicability of the proviso has to be construed liberally. So very important principle Supreme Court brings up. They say that, look, not only the word fraud, willful misstatement or suppression with an intent to evade requires some positive act on the part of the taxpayer to be able to for the department to be able to make an allegation of imposing penalty. The burden is on the department. Only if the department discharges the burden, then the taxpayer will have to then discharge the onus by responding to that allegation based on the evidence which is put across to the taxpayer by the department in terms of notice. So in many cases, you will find that department does not discharge the burden which is envisaged under law. In those situations, you can certainly rely on this decision to say that, look, as far as penalty is concerned, the burden is not discharged. Simply saying that because their proceeding, their audit brought out that fact is not good enough for the department to discharge their burden. And therefore, in that situation, neither the extended period is invocable nor penalty is imposable under section 74(1). This is another landmark case, HMM Limited. Again, these are all Supreme Court cases. Now, here again, one more facet of this law has been brought out. Again, very important. What it says that, look, all these three situations, that is fraud, willful misstatement, or suppression, they are all distinct situations. They are not one situation. A fraud is basically a situation where someone takes a series of actions to hide a certain fact, to take a certain unjust benefit of law. So fraud operates at a level where an assessee indulges in series of actions, series of activities, brings out a scheme which demonstrates that the idea was to commit an evasion through that scheme. Willful misstatement is where he is stating something, but willfully he is stating incorrectly. So he knows that the product is of this character, but I am willfully indicating that no, my product is something else, and thereby it is resulting into non-payment or short payment of tax. Suppression with an intent to evade. I know that these are the ingredients of my product, but still I'm not bringing those ingredients on record. Nowhere it is coming out on record. So I am willfully suppressing that information. I am not sharing that information. And therefore, if it is found ultimately that basis that information, I end up resulting into non-payment or short payment of tax, then in that situation, it can be said to be a case of suppression. So all these three situations are independent. Supreme Court in HMM says that, look, if the department is alleging that larger limitation period is invocable and penalty is imposable, then department cannot just say that this is a situation of fraud, willful misstatement, or suppression. They will have to point out of the three, which is the case which is present in the given facts. If the department is not able to enumerate in their show cause notice as to which of this offense has actually been committed by the taxpayer, then the court says that the allegation cannot sustain. So again, a very important principle. One, again, when you get a show cause notice, kindly read the notice, kindly see when it comes to a proposition for imposing penalty. Are they saying because of fraud it is impossible? Are they saying is it because of willful misstatement, or are they saying that is it because of suppression? Basis that you can then frame your line of defense considering the available facts of the client. Pushpam Pharmaceutical Company, again, Supreme Court indicates that, look, all these words are very strong: fraud, willful default, and if such strong words are used, then it has to be understood that not correct information, that only when the correct information was not disclosed deliberately to escape the payment of duty, only in that situation penalty is imposable. So in a situation where, let us say, both the parties were aware of the facts or aware about the confusion prevalent in law, like for instance, let us say when we say that the case involves availment of credit related to construction expenditure, when you have given the unit on rent, where on the rental income you are paying GST. Now you are already aware, Orissa High Court already takes a view in the case of Safari Retreat that credit is admissible. Clause B of section 17(5) has to be read down further so as to say that in such situation also credit is permissible. Now the matter is sub judice. Matter is right now pending in the Supreme Court. Let us say this is an information which is available to both the parties. Now, basis this information, you take a view in your return that credit is admissible and you avail the credit. Tomorrow, department disputes the claim of availment. On merits, they say under 17.5, credit is not available. For penalty, they go to 74.1 and they say that, look, because of fraud, because of willful misstatement, because of suppression, penalty is impossible. In such situation, they will go to the last category, suppression, to say that, look, this information was suppressed, that you are availing the credit related to construction expenditure. But is that really the case? The case was never about suppressing information related to which credit is taken. The case really relates to whether credit of construction expenditure in such situation is available, which is already an information available to both the parties, to the assessee and the department. We already have a decision of a court. We are awaiting the decision of the Supreme Court. So this is not a case of suppression at all. So in such situation, if the department is alleging suppression to say that because of that you suppress that information, then the information which has been suppressed was never deliberately suppressed. That information had no, in fact, that information was only factual in nature. What is really up for contention was the interpretation of law, and basis that interpretation of law, ultimately your claim would get decided. So this is not a case where one can say that the information was deliberately hidden. So again, this is a classic principle that you can apply in such situations to say that penalty is not impossible or larger limitation period is not impossible. Again, in Jai Prakash Industries, the Supreme Court takes a view that when divergent views are available, where in fact various high courts were having bona fide doubt as to whether a certain activity can amount to manufacture or not. In that situation, Supreme Court takes a view that again, extended period of penalty is not impossible. Eastland combines. Again, Supreme Court takes a view that positive act, again, it reiterates what we already saw in Kemper drugs, that a positive act is required. A mere failure to disclose is not enough to impose a penalty. Denson's case. In this case, related to the issue of classification. Ultimately, the court takes a view that for invoking the extended period or for invoking or for imposing penalty, there should be a willful suppression. In this situation, the assessee had written a letter to the department indicating that their goods are falling under a particular heading. Eventually, it was found their goods actually fell in some different heading, which attracted higher duty. Still, the Supreme Court takes a view that, look, information was available with you, that under which head the assessee was clearing the goods and the basis for choosing that particular head. In that situation, later down the line, department cannot say that that information was suppressed, willfully suppressed, and therefore it attracts penalty. Now, this is very important even in our context, for the reason that in your GST annual return and audit, whenever you find a situation where you find that you have taken a view and the law is not clear, I would always suggest that you mention that aspect in your audit report, in your reconciliation statement. Earlier it was audit report, now it is a reconciliation statement. In that statement, please elaborate your reason of taking a view and say that has been taken in this particular year and with this reasoning. Why I'm saying this? Because right now nobody is going to read your mind. It is only after 3-4 years that the officers would read this statement and then take action, or during the audit they will read this statement. By that time, it is quite possible that the normal limitation period might get over. It is also possible that even if they come within the normal period of limitation, still, since you have willfully disclosed that information, even if you lose on merits, eventually, let us say your case is not does not find acceptance by the court, Even in that situation, you will be able to save from penalty for the reason that you had disclosed. So the question of willful suppression would never arise. So one should keep this decision in mind and accordingly may consider disclosing certain additional details, because Form 9C is not stopping you from making an additional disclosure. Again, Anand Nishikawa, same principle is reiterated, where they say that suppression requires again some deliberate action, deliberate act. Mere omission is not sufficient. Continental Foundation, again, I think it reiterates the same ratio. Right. Again, here again, the question of burden is there, where again revenue, say it is on revenue first to discharge the burden. An incorrect statement cannot be equated with willful misstatement. Pepsi Foods, again, this is again in the context of what we are already discussing, where again the court says that the ingredient of the offense will have to be factually demonstrated. Mere assumptions will not be enough for the imposition of penalty. Again, see, as far as even onus of evidence is concerned, again they are saying it is onus is on the department to provide the evidence as to on what basis the appellant had committed a fraud or a willful misstatement or suppression. If that is not discharged, then penalty cannot be imposed. Whenever this is again a decision of Allahabad High Court, where Allahabad High Court takes a view that look, when your own circular you are changing the stand. In a certain circular you are taking a stand A. In subsequent circular you are taking stand B. This is also quite regularly happening in GST. In that situation, the Allahabad High Court takes a view that in such situation, it cannot be said that the taxpayer has committed any fraud or any willful suppression or any willful misstatement, for the reason that the law basis which now recovery is sought to be made, that law itself was not clear. Your own circular kept on changing the position, and therefore in that situation, the question of mens rea or question of guilty mind should not arise. Now, this is a decision under the VAT law. Again, it will be relevant because, as we discussed, all the elements under 74(1) or 122 require the presence of a guilty mind. So, it is in that context that Supreme Court in Hindustan still takes a view that what is required is a conscious attempt on the part of the taxpayer in disregarding the obligation. Only if that is demonstrated, then the penalty can become applicable. Again, these are all the decisions. These are decisions where in audit objection, certain demand is raised. Tribunal takes a view that look, if, when a taxpayer is bona fidely paying tax regularly, filing the returns regularly, it is bound to happen that during departmental audit, some minor infractions or some minor issues are come on record, and taxpayer immediately agrees and pays the amount. In that situation, where is the question of suppression or where is the question of any intention to evade? Again, a good principle will be very helpful in the context of GST also. So during the audit, if some minor lapses are identified, one can rely on this decision to say that in such situation, taxpayer agreeing to pay the tax and interest should be sufficient. Question of penalty should not arise. This is a Gujarat High Court decision in a case where the dispute involves service tax, where the customer refused to give service tax on the basis that tax is not leviable. On that basis, the petitioner did not pay the tax. Ultimately, department makes the recovery. Gujarat High Court takes a view that look, in such situation, there were bona fide grounds for the petitioner in terms of not paying the service tax. And in such situation, the question of suppression or question of evasion was not on their mind, which resulted into the non-payment, and therefore in such situation, the penalty or extended period is not invocable. Now, this is the decision in the context of Nissan Motor, where again it indicates that look, mere non-disclosure is not enough to be a foundation for willful neglect. The court says that look, we are not persuaded by this argument. Onus initially is on the department, and that has to be on the factual foundation. Only if that is discharged, then the assessee would be put on adequate notice to respond to such allegation, resulting in higher penalty. In absence of such allegation in so-called notice, mere non-disclosure is not good enough reason to impose higher penalty. This is a very latest decision. In fact, last week only it has come in the case of Reliance Industries Limited. It is again by a Supreme Court, where Supreme Court takes a view that merely because there is a self-assessment scheme, and under a self-assessment scheme, the assessee is required to self-assess and pay tax. And therefore, if something is ultimately found, which is beyond what has been assessed by the taxpayer, that automatically does not result into fraud or willful misstatement or suppression. Again, goes back to all the past decisions to say that some positive act is required for the department to confirm penalty. Now, this is in the context of redemption fine. See, under section 130, if your goods are confiscated because you have violated because your case is covered in the situations under 130, there is an option to pay a redemption fine and seek a release of the goods. Now, one may say that because my goods have been released, am I also automatically be not liable for any further consequences in terms of penalty? That is not so. Supreme Court takes a view in Western components that look, payment of redemption fine to release your confiscated goods is merely to take back the ownership of the goods which vested with the government when they confiscated it. That in any case does not absolve you from the consequences of penalty if ultimately, if in the adjudication it is found that those goods were illegally supplied or those goods were illegally possessed. This is a situation where the Allahabad High Court takes a view that look, if the input tax credit has been availed but not utilized, and before utilization, if it has been reversed, then the question of interest or penalty would not arise, because as we already discussed, penalty arises if, see, plain reading of section 74(1) may suggest that look, even on an availment of wrong ITC, 74(1) is invocable, because 74(1) uses the language ITC wrongly availed or utilized. That word "or" indicates as if merely on wrong availment of ITC, the consequences of 74(1) may get attractive. Now, when you look at section 50, subsection 3, when it comes to imposing interest, the law says interest is imposable only if the ITC is wrongly availed and utilized. So unless it is not utilized, question of paying interest would not arise. For penalty, there was always a question mark that what about penalty? For basic amount, since it has not been utilized, I may reverse it either in pursuant to notice under 74 or even voluntary. Interest in any case is not imposable under 50 subsection 3. But what about penalty? Can penalty still be imposed under 73 or 74? The answer would be no, for the reason that what Allahabad High Court says in the decision of Ashoka Metal is that if you avail the ITC and reverse it before utilization, even if reversal is even after the department identifies that that credit was wrongly availed, that tantamounts to non-availment of the credit. And that is the basis of that proposition is the Supreme Court decision of Bombay Dye. So once it is established that credit itself was not taken, then the question of recovery of that credit under section 74(1) should not arise. And therefore, the question of penalty under section 74(1) or for that matter, even section 73(1) should not arise in a situation where ITC is reversed before the utilization of such ITC. Bombay High Court in the case of SL Propec it takes a view that, look, to constitute a fraud, there must be an intent to deceive. If an allegation is made, inquiry is important, and basis that facts are important. Unless those are not established, mere allegation is not good enough to conclude that there is a fraud. No inference can be drawn based on such assumptions. Again, a very useful decision. This is a recent decision, so I thought I should cover. Now, on revenue neutrality, as you can see on your screen, these are all series of decisions where starting from Supreme Court to the tribunals, a consistent view has been that if the situation is revenue neutral, there cannot be a question of fraud or any willful misstatement or suppression with an intent to evade. Why that is so? Because in any case, if the taxpayer would any case be available for the benefit, then in that situation, there cannot be any intention in the mind of that taxpayer in not paying the tax or not claiming any wrong credit. So in a situation like, for example, where liability and the reverse charge mechanism is not discharged, credit of that tax, even if had it been discharged at the original point of time, is available. Even if you are going to discharge now, credit is available. In that situation, if it's a revenue neutral situation, one can very well say that department may recover if I have not paid. But question of penalty should not arise under 74(1) because this situation was not on account of any fraud. Similarly, let us say on the outward side, you are supplying the goods to your sister concern, where you can demonstrate that credit is available to the sister concern. Department alleges undervaluation. In that situation, again, the situation is revenue neutral, and therefore you may have to contest on merits as far as demands of tax is concerned. But when it comes to demand of penalty, on this ground of revenue neutrality, you can very well say that the extended period or penalty cannot be invoked. Government entities, these are the decisions where the courts have said that, look, when a question arises of government entities, question of suppression is not there because there is no personal gain one can make by the persons working in such entities, because all these government undertakings, government-owned companies, whatever surplus, whatever gain that remains, that goes with the government. So it cannot be said that these entities are operating with a intent to suppress the facts to evade the payment of tax, because ultimately it is the government to whom tax goes, and those are the very entities who are basically functioning, and therefore the tribunals take a view that in case of government entities there cannot be any personal gain, and therefore the allegation of fraud or willful misstatement or suppression with an intent to evade should not arise. Now let us quickly go, before I end with certain issues, let me just take you through some important GST case laws that have come on this topic. Now, this is a case which was before the Kerala High Court in the case of Y. Balakrishnan, where the issue involved was that under section 130, that is confiscation, where there is a provision for provisional release of the goods, whether that release can happen merely on payment of the redemption fine, or whether the payment of tax, interest, and penalty is also required for seeking the release of the goods. Department's argument under section 130 was like this, that look, under section 130, only the goods, see, number one, under section 130, there is no time limit prescribed for the department to pass confiscation order. The department may take their own time in passing the confiscation order till the time the goods remain under the ownership of the government. I mean, that situation, if someone wants to seek a release of those goods, then the law says that he has to pay a fine, which is equal to the tax amount involved. Now, in that situation, if let us say if someone wants to opt for that option, department takes a view that that option is available only after the confiscation order is passed. That option is not available before the passing of the confiscation order. Kerala High Court takes a view that that is not the fair reading of the law. Section 130 provides for two situations where a person can seek the release. One is before confiscation, passing of the confiscation order, he can pay this fine and seek a release, which is coming out from subsection 2. And then there is another subsection 7, which says that once an order has been passed and goods have been actually confiscated, thereafter also he can pay the fine and he can seek the release of the goods. Kerala High Department here argued that, look, considering subsection 7, it implies that release can happen only after confiscation proceedings are over. Kerala High Court takes a view that no, in fact, the subsection 2, the way it has been structured in section 130 itself implies that that option is available before passing of the confiscation order. And therefore, in this situation, the party was right in seeking that option, and the officer was wrong in denying that option and releasing the goods. Another issue was that what would be the basis for calculating the market value, because the calculation of fine is based on the market value of the goods. The department wanted to take MRP. The Kerala High Court takes a view that no, in any case, it has to be the taxable value, and therefore, if the taxpayer is able to demonstrate, if the invoice is available, then that can be considered as a good base. Alternately, if the taxpayer is able to demonstrate that the actual market value of the goods is this much, then MRP cannot be considered. The actual transaction value will have to be considered. Now, this is again an important issue. This I will correlate with the recent amendment that has come in the context of PMLA. So this is a situation before in the case of Govind Enterprises, where in this case, what happened was that this is the party who was alleged to be committing an offense of issuing fake invoices. Now, the officer, without taking any action under GST law, that is either by making an arrest under section 69 or launching a prosecution under 132, actually lodged an FIR with the police station under the Criminal Procedure Code, saying that this entity has committed an offense under the Indian Penal Code. Now, as you are aware, Indian Penal Code also has certain list of offenses which attracts punishment. Cheating, criminal conspiracy, these are certain offenses which can also apply in the context of GST, where if someone cheats the government or indulges in a criminal conspiracy to defraud the government. So those set of offenses are in a way also applicable in the context of GST. Here the officer lodged an FIR and police started the investigation under the Criminal Procedure Code to determine the commission of that offense. And if now that FIR was challenged before the Allahabad High Court. Now, basis of challenge before the Allahabad High Court was this, that look, GST law is a complete code by itself. There is provision under 132 to arrest a person and prosecute the person under with section 69. In that situation, the lodging of FIR under the Criminal Procedure Code is incorrect, and therefore the plea was made before the court that this FIR is required to be quashed. The Allahabad High Court was not impressed by this argument. Allahabad High Court takes a view that, look, under section 135 of the CGST Act, it clearly indicates that what you already saw earlier also, it clearly indicates that the commission of an offense under the GST law does not by itself exclude the operation of any other law vis-a-vis that offense. So first conclusion that Allahabad High Court takes a view is this, that look, GST Act never excludes the applicability of Indian Penal Code. So Indian Penal Code stands applicable also to the actions which may also find relevance under the GST law. Then it discusses the question of double jeopardy, where it says that look, under Article 20, sub-Article 2 of the Indian Constitution, there is a clear bar that for a single offense, one cannot be punished twice. So basis that an argument was framed that look, under section 132, there is already a punishment which has been prescribed, which is up to 5 years. In that situation, if that punishment already stands prescribed, then it is compulsory for the authorities to take action under 132 only. They cannot take action under the Indian Penal Code. Again, the Allahabad High Court refers to series of decisions of Supreme Court to say that, look, The offense under the GST law and an offense under the Indian Penal Code can be different. Facts may be similar, but the nature of offense can be different. Now, how the Supreme Court has taken a view in such situation is like this. Supreme Court takes a view that, look, many actions has many facets. So a certain set of actions may have a facet under one law, but that does not mean that that kind of actions may not have a facet under another law. So as an example, let us say you have issued, someone has issued invoice without supply of goods. Now that is clearly an offense, as you already saw under 132. Now that on a larger scale may tantamount to a criminal conspiracy, may tantamount to money laundering, may tantamount to other more serious economic offenses or more serious offenses finding place under the Indian Penal Code. So in such situations, the Supreme Court has taken a view that, look, facts may be similar, but the offense which is given under a particular taxing statute and the offense which is finds place under the Indian Penal Code are different offenses. And therefore, protection of Article 20, saying that for a single act, one cannot be punished twice, is applicable only if act and offense are identical. If the offenses are not identical, if the laws are different, nature of offenses are different, in that situation, Supreme Court takes a view that then the protection of Article 20 is not available. One will have to face consequences under both the laws. Basis that Allahabad High Court takes a view that, look, offense under the Indian Penal Code are different, offenses under 132 are different. Only if, let us say, had they taken an action for the same offense mentioned under Indian Penal Code and the same offense mentioned under 132, in that situation, only the benefit of Article 20 would become applicable. In this situation, the court says that since action has been taken first under the Indian Penal Code, and that action very well is permissible under Section 135 of the GST Act itself, where it does not in fact debar the application of the Indian Penal Code. And therefore, the Allahabad High Court takes a view that the FIR which has been lodged is valid. In fact, Allahabad High Court goes further and also takes a view that, look, under the Indian Penal Code, if you want to convict, the element of mens rea has to be construed substantively. Allahabad High Court then compares the GST provisions and says that, look, under the GST provision, the Parliament thinks fit that for an offense under 132, the culpable mental state is presumed. And since the culpable mental state is presumed, which is not the presumption under the IPC. Under the IPC, there is no such presumption. Under the IPC, through a charge sheet, the department has to prove that there was a culpable mental state. Whereas when it comes to offense under 132, it may follow the same procedure of CRPC. But in that situation, still the presumption would apply because of the law made by the Parliament in terms of Section 135, which says that the culpable mental state will be presumed and it is for the accused to discharge that burden. So basis this Allahabad High Court takes a view that, look, in any case, both laws are different. Action taken in this particular set of facts was considered to be valid. Now, why this is important? Because recently you are aware, a lot of debate is going on that GSTN has been included as one of the party under the PMLA Act of 2002. Now, one has to understand the provisions of PMLA Act. Now, basic objective of that act is basically to ensure that assets created out of the laundered money should not be retained by the offenders. It is a schedule appended to the act which says that the assets created out of the offenses mentioned in the given schedule would only attract the provisions of that act. Now, that schedule has reference to the provisions to certain offenses of Indian Penal Code, which includes what we discussed, the criminal conspiracy, cheating, etc. It has reference to certain provisions of the Customs Act, Section 135. It has reference to provisions of Companies Act. It does not have yet reference to provisions of the GST Act. So inclusion of GSTN does not make any change as far as application of PMLA is concerned to the offenses committed in the context of GST. But yes, if an action is taken under 132, that is an action under the GST law. We does not find mention as a scheduled offense to invoke PMLA. But if the action is taken under the Indian Penal Code, what we are just discussing, the case which was there before the Allahabad High Court. In that situation, that offense finds mention in schedule to the PMLA. In that situation, if ultimately it is found that basis those fake invoices, the assets were created, and those assets would be liable for confiscation under the provisions of the PMLA Act, because that Act has as one of the schedule offense, the offenses under the Indian Penal Code. So that this is not the recent amendment. This reference of Indian Penal Code is there since last 4 years. So what I am trying to say is this, that inclusion of GSTN is only as an entity to permit sharing of information between the other enforcement departments of the government. It nowhere automatically brings GST offenses under the ambit of PMLA. However, if the offense is committed and if the department invokes IPC, then in that situation, certainly that offense finds mention under PMLA, and therefore an action against that person under PMLA is also possible. So that is how one has to look at this situation. This is a Telangana High Court decision in case of PV Ramana Reddy. This is a situation where the question was that if, let us say, department does not go on the IPC route, department goes under the GST route. If the department goes under the GST route to punish the offender, then in that situation, what will department do? First, they will arrest the person under section 69. Then they will invoke 132, file a charge sheet, and do the trial, and ultimately determine whether the person is liable for punishment in terms of imprisonment and fine. Now, if they take the GST route, then what happens? There is no police officer involved. The departmental officer has been given the power under section 69(1) to arrest. Now, if that is the case, then the person who is arrested cannot basically avail the benefit of anticipatory bail, because anticipatory bail under section 438 of the Code of Criminal Procedure is available only if the proceedings are initiated under the said code for an offense committed under the IPC. Now, since the proceedings initiated under section 69 is in the context of offense committed under 132 of the CGST Act, literally section 1, literal interpretation suggests that section 438 does not apply, and therefore such person cannot seek an anticipatory bail if such person is apprehending an arrest. Now, this was the issue which was there before the Telangana High Court. Telangana High Court takes a view that, look, it may be that we cannot grant an anticipatory bail under 438 because the offense, what is sought to be now brought to charges under the GST law. But under the writ jurisdiction of the court, under Article 226, certainly the court can consider it, but then court will consider it in very rare occasions. Court will not generally construe this or use this power in every situation. Second important aspect that the court says is that, look, under CRPC, there are section 41 and 41A which were brought into effect from 2008 and 2011 respectively, which suggests that if the person is cooperating, if the officer thinks that the liberty of the person will not hamper investigation, then there is no need to arrest the person at the stage of trial. The punishment, arrest and consequent imprisonment can happen only after the conviction. Now, whether those provisions can apply in the context of GST, the Telangana High Court takes a view that yes, that can apply. Telangana High Court relies on section 69 to say that, look, when you arrest a person, you are referring to the provisions of CRPC for the purpose of determining the modality in which the arrest will happen, and the fact that since the offense is cognizable and not bailable, so there is a requirement under 69 to produce that person within 24 hours before the magistrate, and then it is for the magistrate to give either bail to that person or judicial custody. There cannot be any police custody because this is not an offense where police is involved. So in that context, Telangana High Court takes a view that, look, 41 and 41A of CRPC can apply. So in a fit situation, under Article 226, a bail can be granted to a person under 41 and 41A. Telangana High Court does not decide the issue of whether Section 69 can be invoked at the stage of investigation or 69 can be invoked only once the prosecution is complete and the person is found guilty of committing that offense. As you are aware, in the pre-GST era, we had the decision of Make My Trip, where Delhi High Court takes a view that ordinarily if the person is filing the returns, paying the taxes, then that kind of person cannot be arrested if during the investigation stage, only after the conclusion of prosecution and conviction. Only at that stage, arrest and punishment is possible. Only in a situation which are grave in nature, where there is where the size of offense, the nature of offense is severe. Only in that situation, Delhi High Court takes a view that during investigation, arrest is permissible. That decision was affirmed by the Supreme Court. But now, Telangana High Court decision, in a way, permitting arrest under Section 69, even before conviction under 132, has been now challenged. Supreme Court is to decide on this, all the issues. Supreme Court has said that in view of multiple high courts entertaining this issue, Supreme Court has taken the hold of this issue, and now they are going to finally decide the matter, considering even the decision of Make My Trip. Now, Jai Chandran Alloys, this is a decision where the question was that this was a petitioner who was harassed. His statement was recorded, documents were seized, but department was not giving the statement, not allowing the copy of documents. And in the meanwhile, he apprehended that the arrest may happen under 69. In that situation, he approached the Madras High Court. Madras High Court takes a view that, look, statement is something which is to be given to the taxpayer. Statement is not the document. The department tried to say that, look, statement we will not give because under Section 67, we have the power that if the document we feel is going to hamper our investigation, if that is released, then that will prejudice our investigation. On that basis, we can only give the copy of statement only after the issuance of show cause notice. That was rejected by the court. The Madras High Court takes a view that no, a statement is not covered under 67. Only documents seized under 67 department can have right over those documents. But a statement recorded of director, a copy of that is required to be handed over immediately to that person. This is very important because many times we find that basis the statement, all the allegations of fraud, willful misstatement or suppression are made. So therefore, a copy of this statement should be asked, and basis that a proper retraction supported by the facts can be submitted. Now, last 5 minutes, these are all open issues. What we discussed are all important decisions, pre-GST era as well as GST era, where certain important principles have already been culled out by the courts. This is a topic which is factual and legal. Now, what are the issues? First issue is this ITC. We already discussed this CBIC Circular 171, where we discussed that if, let us say, the allegation is that you have taken fake credit and passed on fake credit, then the proceedings cannot be initiated under 74. There is a separate scheme in the Act under which the proceedings are required to be initiated. Now, whether penalty under 74(1) and 122(1) and 2, how do we reconcile that issue? Now, here, it's a very interesting issue. Let me tell you why it's an interesting issue. It's an interesting issue because 74(1) says that officer can issue a notice to recover whatever tax evaded or ITC wrongly availed with penalty. 122(1) talks about a taxable person committing a series of 21 listed offenses. 122(2) talks about a situation where a registered person commits an offense akin to an offense under 74(1) in terms of either short payment or non-payment of tax or wrong availment of ITC. So we have multiple provisions in which a penalty is sought to be imposed. We have already seen 75(13) saying that if the penalty is imposed under 74, then no penalty for the same offense will be imposable under any other provisions of the GST Act. Now, in that situation, does it imply that the department is at liberty that in case they want to use 74(1) to impose penalty, they will use 74(1)? In case where they use 122(1), they will use 122(1) or 122(2). To my mind, a harmonious interpretation is required. I would say 74(1) and 73(1) are actually linked with 122(2). 74(1) and 73 does not specify the quantum. They only say that notice can be issued to recover penalty. The quantum of that one can find mention in subsection 2 of 122. So that is how both are to be understood. 122(1) we already discussed, deals with 21 unique set of situations where if that offense is committed, then the penal consequences are attracted. So one has to see the exact allegation in the notice. If the allegation is not akin to 122(2), but it is more on 122(1), one can certainly make a submission to say that, look, what you are alleging under 74(1) may be fine as far as basic amount is concerned. But when it comes to penalty, if you are choosing 122(2), when actually that offense is under 122(1), that can be a good ground to say that penalty is not imposable. Now, during transit, again, see, right now, a lot of cases are pending in the Gujarat High Court where the issue is like this, that look, the goods are moving, goods are detained. You take an option under section 67, read with section 129, you pay 200% of penalty and seek the release of the vehicle along with the goods. In that situation, can 130 at all be invoked? Because 130 is consequential to 129. Although it has a notwithstanding phrase where 130 says notwithstanding 129, it's a separate provision permitting confiscation. But can the goods which have already been released can still be confiscated? Because confiscation naturally flows detention and seizure. So if on one hand the law itself permits the release of the goods before initiation of 130, and if the taxpayer has opted for that route and paid 200% of penalty, then in that situation, can department at all go into 130 at all? Now, that's an issue which is open. Currently, the High Court, especially Gujarat High Court, is considering petitions on this very issue. Let us see when the High Court decides on it. But again, something which has to be kept in mind when you face a situation under 130. When that situation is already covered under 129, in that situation, certainly you can take this ground to say that if you have already paid amount and sought the release of the goods, then invocation of 130 is not permissible. Confiscation and prosecution, I think we already discussed many issues as we move through various cases. Last, even GST and PMLA, we already discussed that by bringing GST, it does not change anything as far as PMLA is concerned. As we already discussed, if the department pursues the route of filing a complaint and registering an FIR, and basis that if the department wants to take action again under the Indian Penal Code, then certainly in that situation, PMLA provisions also would get attracted. So this concludes from my end. If there are any questions, certainly I would be happy to take it. See, this topic is vast. 2 hour, 2.5 hour may not be enough, but all the key principles we've already discussed, especially all the past case laws where I find they are applicable, we have discussed. I will also share this presentation. So you can refer to these cases at length and see how you can apply that to the day-to-day facts that our cases that you come upon. So with that, I again thank the association and all the participants for a very patient listening.
Siddhant, can you take over for the question answer? Maybe find.
Sure.
Yeah. Hi. CA Dinesh ji has a question. So if you can unmute and ask the question.
Good evening, sir.
Good evening.
Sir, basically, our client company take the ITC through ISD registration, pass the ITC through filing the ISD return. But during the tax assessment, during the audit, department identify that that service consumed at head office level, so cannot transfer by the ISD, should be transferred by the cross charge mechanism. We also assess that yes, we are mistake. By mistake, we transfer the ISD instead of the cross charge, but no any tax evasion because all our service eligible service, only the procedural gap. In that case, a department can penalize interest penalty.
See, this is a situation, again, as we discussed, it's a revenue neutral situation. And we already seen large number of cases where in a revenue neutral situation, so this is to your own unit, you are transferring the credit. There is no other legal person who is involved. In that situation, certainly the question of fraud or question of evasion would not arise. The question of penalty, to my mind, should not arise. How to regularize it, you will have to see based on your facts that is it really a service which is consumed by the office and used by the office in providing some support services to the other office. In that situation, the modality of cross-charge may be adopted. If you still find that no, this is a service which is directly benefits the respective branches, only for accounting purpose, the invoice goes to the office and then the credit gets distributed. In that situation, what you have done under ISD sounds to be right. So, this is the nature of expense, the nature of supply, you will have to take a call. But as far as penalty is concerned, I don't think in such situation penalty can be imposed.
Okay, sir. Thank you, sir.
Sir, we had one more question in the chat box asking for what would be our view, what will be your stand for the late fee for GSTR1 under section 47.
See, late fee stands on a different pedestal because late imposition of late fee only has one element, and that is delay. There is a delay, the fee gets attracted. There is no mens rea in a way attached in the provision under section 47. As we discussed in 60s, 70s, the Supreme Court was kind enough to consider that even in civil law, whenever such kind of recovery is to take place, then certainly an intention of taxpayer in evading the tax is essential for the department to be permitted to recover such amounts. Of late, as we have also seen in certain decisions, especially the saw pipe decision, where the courts are saying that, look, when it comes to civil laws, and we are dealing with a civil law when it comes to GST, in a civil law, mens rea would become relevant only if the parliament through language authorizes the presence of a guilty state for the officer to be allowed to impose the penalty. So in that situation, as we saw 74(1), the language clearly indicates that guilty mind is must. 122(1) also we saw the list of offenses indicates that the presence of guilty mind is required. But when it comes to 47, we do not find anywhere in the language that the late filing should be with an intent to evade. Late filing is a late filing, and if that happens, then the consequences follow. So unless government exercises their power and reduces the late fee, which they have been doing it, of course, much late than we would expect. But in any case, that much benefit one may avail. On the larger ground of equity, look, under Article 226, certainly anything can happen because 226 gives the wider power to the high courts to do justice. But looking at how the courts are now interpreting all these provisions, it's difficult that under 47 one can expect some relief unless one has a very genuine case, like for example, if floods are there and because of that he could not file the return. Now dates are not extended, and not just one petitioner, maybe 100 petitioners go to the High Court. In that situation, certainly the outcome could be different. But in isolated cases, because of local issues, administrative issues at the end of taxpayer, if there is a delay, then I do not think that would be good enough reason for seeking a relief as far as late fees concerned from the court.
So we had one more query from Mr. Anupam, that can an audit and assessment which has already been completed under 73, can it be reopened under 74 for the same year?
No, see, that is settled now. Already you will find that once an audit has happened of that year, it is presumed that they have looked at all possible records. Whether actually they have looked at or not is not material. What is material is that they have issued an audit notice. Basis that notice, they visited the premises or the necessary documents were given to the office of the department. Basis that they concluded the audit, issued an audit report indicating certain violations. Now, if for that very year, now subsequently, if they initiate some new proceeding and allege that those non-payment of what they find in the second set of proceeding was on account of fraud, that allegation would not sustain, because in any case, the information was available during the first round. Series of decisions you will find from the Supreme Court, where the court has taken a view that subsequent SCN for the same period can never have an allegation of fraud. With the first round of proceeding, you are already privy to all the information, and therefore the question of department of the taxpayer suppressing an information or willfully misstating the information would not arise in a second round of proceeding for that very same year. So extended period and penalty should not be imposable in such situation.
So I also have one personal query for one of my client. They took GST registration long back and they had no sale, nothing, and they forgot about filing any returns. So 2-3 months back, the registration was cancelled, and then they came to me saying that this was a registration which they were not aware of as such. So they didn't even have sale in that firm. But while finding 3B, because before 2021, November 2021, the late fee was 10,000 rupees per return. After in 2021, it became 500 rupees per return. So it is coming to a very substantial amount of 2-3 lakh rupees late fee. So is there any way it can be that the late fee can be reduced, or is there any other way out of it?
As we discussed, under 47, there is no discretion. Only a court under 226 can help in a fit situation. So that is unfortunately, that is the sad reality, but that is something that we will have to live with.
So one more question Subha has. So if you can unmute. Shubha, am I audible? Do you have any query?
Siddhant, can you unmute her?
No, I don't think there is any other query as such, and all the queries have been resolved.
No, she has unmuted herself. Subha? No response. Okay. Then I think, Siddhant, you can close the session for today.
Yeah. So the address given by you, sir, was a very extensive, and it covered all these sections in detail, along with the case laws dealing with starting from what offense and penalties are to each and every case law that's happening. So it was a very amazing session, sir. Thank you so much for coming. It was a very eye-opener, and so it is very oftenly said that tax is the most difficult thing in the world to learn. You helped us to get one step closer and understanding the complexities of GST law. Thank you so much, sir. And we would also like thank to all our participants who have participated in this certificate course. Thank you for your time. And we really hope to see you again tomorrow for the second session of this series. And that's all from this side. Thank you, sir. Tarun bhai, if you have anything to say.
Can you present the e-memento, please?
Yes, sir.
Sure, sir.
We would like to present the e-memento to sir as a gesture of the amazing session today. Thank you so much, sir, for your time.
Thank you so much. Thank you so much.
Thank you, Abhayji. It was really a wonderful session, and we all got to learn so many things. In fact, I thought that there were so many things that we could have also covered because of the multiple case laws that we get to see on a regular basis. But you have tried to capture all of the important ones in such a wonderful session. And I will request that if you can share the PPT with us, we will send it to
Certainly,
all the
certainly.
participants.
Sure, sure. Thank you so much.
Thank you so
Thank you
much,
for
sir, for your
inviting me.
time. It is always wonderful
Thank
to listen to you.
Same here. Thank you so much. Bye.
Thank you so much. And thank you to all the participants. So we will close the session for today, and we will meet you again tomorrow at 5 p.m. Thank you so much.
Thank you, sir.
Thank you, Siddharth.
Thank you. Give you.
Thank you, Shubham.